employees who had been with the business when we re-IPO'd it, they ended up making 100% of their income in stock. In aggregate, we had 16,000 workers around the world who all were owners, all are owners today, and created about $700 million of wealth for themselves. And all the while, like, our investors did great. We made more than 4 times our money on that deal. And so it's such a example of how this can work. We can have investors do well, employees do well, and this doesn't need to be a zero-sum game. Ownership Works is an effort to take what we've done at KKR now 30 some times. We've rolled this model out more than 30 times and expanded across the industry. And this was Ownership Works was a nonprofit that initially my wife and I were just going to start, and it ended up being a real consortium of investors, and we're working with labor unions and nonprofit foundations and pension funds. So we have like 100 organizations around the table trying to make this a more common model. Why can't we have an economy where everyone's participating? For all the talk of inclusive capitalism, wouldn't this be it? Like, where people are actually included in the capitalistic model? That's kind of the dream. And the flywheel is starting to turn. I mean, we've got not only our 30 companies, but all the other partner companies at Ownership Works. They're rolling it out in their portfolio. Mm-hmm. We are now, when we're exiting these companies, we have the next private equity buyer. If it goes to a private equity firm, they're replicating the program. So you get examples where an employee who makes $55,000 a year makes $100,000 in our exit, and then the next private equity firm reloads them, and they could make another $100,000 in the next deal. So I think this is a big deal. I think this is how capitalism should work and is where we need to head.
Very interesting. It's probably hard for a private equity firm that inherits a company from you to then pull the program back if it's popular. But what is the requirement for members of the nonprofit Ownership Works? Do they commit to a specific percentage of their investments or portfolio companies adopting, employee ownership, or is it just a way basically to share know-how?
Yeah, so it's both. It's, first of all, if you're going to be a member of Ownership Works, you have to agree to certain standards. So as an example, what we don't want is workers investing out of pocket and taking financial risk. We don't want workers trading a 401k benefit for stock, or trading wages or wage increases for stock. So it's got to be, we have all these standards you must agree to. One of the foundational ones being, this must be a free and incremental benefit for workers, and the company will earn a return on that by having an enhanced culture. We then work with all of our member companies on, how do you roll these programs out? How do you communicate them? How do you teach employees about ownership? How do you create an ownership culture? How do you amplify the voice of the workers in the company? And yes, members commit to roll this out with at least 3 companies over their first 18 months of membership. Mm-hmm. But many companies, many firms, Leonard Green, Berkshire Partners, et cetera, they're rolling this out all over the place. I think Berkshire Partners, I was talking to one of the partners there yesterday, has this at 8 of their portfolio companies already. Leonard Green has this at many companies. We also have, TPG and Advent, and there's a lot of the big and small private equity firms who are rolling this out in their portfolio.
What is a typical percentage, as total capital of equity you see companies allocate for their employees, and where does it usually come from? Is it coming from new equity and dilution throughout, or just from management, or like, how do people approach it generally, you find, and what tends to be effective?
So for a typical private equity deal, put aside for a second whether or not all employees participate in ownership. In general, I would say that's in the 10 to 15% range. So there'll be an equity pool set aside for employees in the 10 to 15% range. Now, in a typical private equity deal, that would all go to the very senior folks. And maybe it's on the low end of the 10 to 15%. What we do is we move a little bit up the scale in terms of the size of the program, and we allow everyone to participate. And the great part about this is, in a levered capital structure, if you run the math on, if I had a 10% pool for employees versus if I have a 12% pool, it's a rounding error. Mm-hmm. Over a 5-year period. I'm talking about literally basis points of return. So the break even in terms of what do I need to believe for this to work is very low. Usually it's 1% of EBITDA. You got to find 1% more, 2% more EBITDA over 5 years for this to break even. We had a major consulting firm do an analysis of our programs and found a 10-to-1 return in their estimation. When you look at higher engagement, lower quit rates, you don't have to recruit and retrain all these folks. It just makes for a much more efficient business.
That's very interesting. And I understand you're trying to expand this to Europe as well. Talk a little bit about, working with unions, different regulatory regimes. I see a question in the audience about specific adoption in the UK and Germany, if it's challenging there. How has the rolling out of it been like, around the world?
Yeah, so we're a little bit earlier in rolling it out around the world. We have rolled it out a few times in Europe. I think you'll see more of that from us in Europe. But even in the US, as it relates to unions, we've rolled this out in our own portfolio with unions. It's got to be a negotiated benefit, even though it's free and incremental. You can't go to a union. You can't go direct to employees. You have to work through the union. It needs to be bargained, even if it's free. And look, I think, and I'll just call one union out in specific. I just have like a ton of respect for Mary Kay Henry at the SEIU and her whole team in how they're thinking about capitalism needs to change and workers need to be included. There had been historically a view, if you're a union and an employer starts giving equity in the company to your members, it's a weird dynamic because the union views the employees as their employees, not the company's employees. So if the company then starts, through ownership, aligning employees with the company, not the union, that's a weird setup. But some of the more progressive union leaders know we need to change the economic model and are very open to this type of setup. So I would just say, even in the US, we've rolled this out with unions at Ownership Works, even in companies that we don't own. So through the nonprofit Ownership Works, we rolled this out at Harley Davidson, which is an all union workforce. And in Europe, this whole supervisory board structure, if that's where the question's coming from, is not really an impediment. I mean, again, this is the perspective has to be, this is a free incremental benefit. It's a way for people to participate. It's the foundation of a different type of culture where workers have a voice. That's the spirit of this. So, in my experience, no union is really opposed to it. As long as you negotiate it through the union and it's a free incremental benefit, I think it's a win-win.
You mentioned Harley Davidson, and of course, I think a couple of other publicly listed companies that have adopted, the program now. Used to be KKR companies, but how have you find the approach of public companies towards the initiative? Is there a little bit of resistance there, particularly when it comes to publicly listed companies? And if so, why do you think?
Well, I think it's harder for a couple of reasons. Number one, they have a more complicated governance model. So as you think about how could we roll a broad-based employee ownership where everyone's participating in outcomes, how could we roll that across the economy? Private equity is not perfect. Obviously, no governance model is perfect, but private equity is an awfully efficient mode of governing in the sense that, let's imagine I want to go get 1 million employees on this program. If I went into the public market, I would need to go CEO by CEO and board by board, and it would take the rest of my lifetime. Or you go to one major asset manager. I mean, we have 700,000 employees ourselves. If you convince a major asset manager that this is the right thing to do, and by the way, if it's done well, is good for returns, bam, you can get 1 million people. So I think we have a better governance model for this. It's more easy to roll across many companies, changes like this. And we are authorized as fiduciaries and decision makers to make these decisions. We don't have the same complexities around boards and shareholders. And, if we are convinced this is the right thing to do, and we're the biggest investor in our own funds, and this is going to be better, not just for workers, but for our investors, we can do it, and we can do it quickly.
Have you explored the possibility in the US or other parts of the world of government basically helping this in terms of, tax considerations, helping an employer basically do this?
There's opportunities for sure. I'm not prepared to talk about it yet, but there's
okay. Sounds like an obvious area to go to. Yeah,
There's
absolutely.
opportunities.
Got it.
Business, first of all, employee ownership is not going to solve all of our problems. I'm not that naive, but this could be a step in the right direction. And I also know that business can't do it alone. Business alone is not going to solve our problems either. We need government and business working together.
Makes sense. Moving on to a couple of other topics. I'll just take now audience questions on a couple of issues we haven't touched on. One is Asia. In this current environment, and obviously a very diverse place, but how, because, I know KKR, for example, has been like, a pioneer in Japan. How do you approach deals at the moment? What areas are you focusing on? Where do you see the opportunity in Asia?
So in terms of the types of situations we're looking for, it's back to that first principle of we want good businesses that have untapped potential. So we've done a huge amount of carve-outs in Japan. These unloved businesses, underinvested in businesses, that is our bread and butter in Japan. But even across Asia, where we've had really good success, is that core concept of good business, strong market position, good customer feedback, but it's not optimized. And there's ways to really inflect growth or innovation or drive productivity, et cetera. So that's what we're looking for. The tricky part in Asia right now is obviously things are changing rapidly in China, both in terms of where the government wants foreign involvement. There's now this reverse CFIUS concept in the US, where the US government has an interest in what's happening in Asia with foreign investment, in China with foreign investment. So that's causing a pivot, I think, for people to migrate more to Japan and India, which are the other big hubs of private equity activity. So those will get more competitive as people shift resources away from China. It's a complicated environment. As you said, these are all, whether you're talking about, Vietnam or India, Japan, Korea, China, these are all, first of all, very far apart, and they're very distinct markets. And you've got to have real country depth like we do to be effective.
Have you given up on new investments in China at the moment? And I know people always end up having China exposure one way or another, but like on the private equity side, do you pursue any investment opportunities in China anymore, maybe indirectly, or no?
Yeah, for sure. We do.
Oh.
Our executive chairman of China, Ming Lu, is based, executive chairman of Asia is based in China.
Okay.
So no, we're not giving up. It requires a rethink and some real thoughtfulness. Again, from a geopolitical perspective, not only where does the Chinese government want foreign involvement and what sectors are they going to support, and where does the U.S. also want to see and not want to see, U.S. investor involvement. So it's complicated, but by no means are we giving up.
Okay, you still see a window there. Another question with regards to LP appetite for specific types of private equity, whether it's sector funds, healthcare or technology, or size of deals, middle market versus like large buyout. Have you seen any recent changes there in terms of people are asking for?
Not really. I would say the one thing I might comment on is there is a renewed appreciation that sector focused funds have more risk. So, it was very easy to make money in software for 10 years, and now it's not. For 10 years, as interest rates went down, valuations, particularly for growth businesses, went one way. And so it looked just so easy to make money with growth investing and I'd say in software in particular. And you just wouldn't want to be sitting on a fund of 100% software deals right now. That's the one thing I would say is there's a renewed appreciation for sector diversified funds. Beyond that, large cap versus mid market, I haven't seen really a shift in interest.
Got it. The energy transition is a big theme at the moment in investment, but also ESG risk when it comes, to fossil fuels. How do you approach energy investments on the private equity side at the moment?
We got out of energy a long time ago, and I'd be lying if I said it was purely for ESG reasons. Energy investing is very difficult. because the underlying commodity is so volatile. And if you use leverage your investing, you've got like natural operating leverage in those businesses that are tied to a very volatile commodity. And then if you add financial leverage on top of that, it can lead to explosive upside, but it's just too risky for private equity style investing in our view. So, we exited energy a long time ago. And then not only was it just not great from a risk return standpoint in our view, but from an ESG consideration standpoint, it made it a no-brainer. So, I'm guessing here we exited that 9 years ago, something like that, 10 years ago.
But other aspects of it, maybe on the infrastructure side, like wind farms, solar farms, or like, pipelines, or like, do you?
Yes, sorry. I was
no
referring
problem.
to,
You say like oil and gas. I appreciate that, and a lot of people think about oil and gas.
yeah, we have a huge emphasis on the energy transition. It's public. We're starting a climate fund. Our infra team does a lot around the energy transition. We found probably fewer things in regular way private equity that would fit the energy transition, but in infra, in climate, we're doing a ton of stuff all over the world. So I apologize. Yeah, I was commenting on traditional energy.
No, and those investments belong to your flagship, private equity fund as well. But you also have this dedicated pool.
Yeah, that's really been more in our infrastructure fund and in this new climate fund. It would be the emphasis around energy transition.
Got it. And a final question. Do you, because particularly financial journalists get fascinated by large deals, big leverage buyouts, which generally haven't seen that many. There was this $18 billion corporate carve out, GTCR buying a majority stake in WorldPay from FIS, but generally we haven't seen big LBOs. Do you see them coming back? Do you see appetite for private equity firms to team up, or just the memories of more than a decade ago when many of those deals generally soured still linger?
I would say mega deals, my opinion, you got to be careful. The history of these has not been great. Look at the top 20 largest deals of all time, pretty subpar performance. They can be great. HCA we led was a phenomenal investment, but many don't. So why is that? One of the reasons is your IRR is necessarily going to be battered by the time it takes to get out of these things. So if there's a $5 billion equity check and you triple your money, take HCA. It was a $5 billion check and it was like a 5x deal. So you're exiting $25 billion of capital over time. And as you delever and the company goes public, the incremental returns you're generating go down because your leverage is less. And that's going to represent a greater and greater proportion of the time that you're invested, those under levered, lower returning years that are later in the investment period. So I think they can work. Again, HCA as an example, was a fantastic deal. More often than not, they're subpar deals. So we'll have to see how this WorldPay deal works out. I think it's an area to just be cautious.
That makes sense. Pete, thank you so much for the time you spent with us today. Thank you to our audience for all the great questions, and we'll see you next time at another Reuters Newsmaker event. Thank you.
Looking forward to it. Thanks, Greg.
Bye-bye.